All right, good morning, everybody. There's something wrong with the restream this morning, so it's all going to have to be done on the Zoom. Bosick was chipping his teeth this morning. Now we got Fed's George. So a lot of Fed speakers. It's all a part of the Jackson Hole. So we've had a little bit of rocking and rolling. The market was up more than 1%. We want to keep our eye on, is there going to be any real big economic events scheduled? And as we can see, there's really not a whole lot. It all comes down to what people are saying. It's going to be Fed speaking all day long, and inevitably, sooner or later, someone's going to put their foot in their mouth. Right? Someone's going to choke on it and say something that the market doesn't like, and we'll see some reactions from that. Jerome Powell's not supposed to speak until tomorrow at 10 a.m. Now, that doesn't mean that they're not going to catch him running around and maybe ask him questions, because Bloomberg, for an example, is sitting inside the symposium and they've got people walking around and, they're just kind of catching individuals on the fly and asking them questions. So you could see, maybe an off-the-cuff interview. The main thing, though, is going to be the 10 a.m. speech tomorrow. And I'm a little surprised at all that there was even a move in the overnight hours, but we've seen in the last week how when there's a lack of volume, you can really get those movements in the market, right? Because it doesn't take as much. All eyes right now continue to stay focused on this. We're looking at a 60-40, 60% chance of a 75-point rate hike versus a 40% chance of a 50-point rate hike. It's really worth keeping your eye on this. Now, we're so close to September that it's just passing everything back and forth. And we're so close to the Fed event for tomorrow that there's like no edge in looking at this one. But you kind of got to also think ahead and say, okay, well, after September, what's the next Fed meeting? November 2. After November 2, where's the next Fed meeting? December 14. So we still have 3 Fed FOMC meetings this year. And you can see the probabilities that they've kind of laid out here. And down below, you can see how the change has come in, right? Because if you're looking at it in a snapshot at this moment in time, what did it look like last week? That would be the obvious question. Well, we can see what it looked like in late July, and then the first week of August or the second week of August. So, you can kind of see how much the numbers have changed. Right now, the chance that we will be basically sitting where they at the 50 basis point rate hike is only 13% chance, right? Because if that's a 50 basis point rate hike that we get in September, when we do get to November, what's the chances that we would stay there, that they wouldn't raise rates? Almost none. How about the idea that they would raise it another 0.75%? None. Right. So you can see how well, that one's not even, that's a 1 point rate hike, right? And what's the chances of that? None. So it's really coming down again to 50 basis points, 25 basis points, 75 basis points. And the farther out you go, the more choices you have, right? Because, of course, it gets farther out in time. We can't quite negotiate what we think it'll be. But right now it's 60-40. Keep your eye on this, see if it begins to change again. The reason I bring that up is think about where we were at when the CPI numbers had come out and the market made it made an assumption that we were going to get a 50 basis point rate hike rather than a 75 basis point rate hike. And the market began to unwind. So we went from this spot all the way up here, and that's what it looked like when they unwound 25 basis points out of the market. Then the Fed kept coming out saying, why are you doing this? We never said we were going to do a 50 basis point, and that a lot of us still think 75 is appropriate. And the market put that 25 points back in again, and we are right back where we were. Okay. So, with that in mind, the market is exactly where it was right before the CPI when the market was pricing in 75 basis points. This is why it's so important to keep track of that tool. If it was to say 100 basis points, we could extrapolate that it would fall down even more, right? Because if this is 75, it's very likely that 100 would be, down in here somewhere below 39. And if they were to do a 25 basis point instead of 50, then we could expect, 44, maybe 44.5. So it matters. While I'm on the SPX, I mentioned the other day that this trend that we were in off of these lows is dead. Now, a new trend could form even from our current location. We could base there and awaken a new trend and continue to the upside. But the trend that we had is dead. That trend is no longer alive. So that rally up off of the mid-July lows and the date that everything changed and all the flows came in with strength and conviction and the push higher, and it's all gone. All right. So we are all looking now for the Fed FOM, or not FOMC, but the Jackson Hole. And then from there, we'll look to see a new trend emerge, or at least breaking these levels and, begin chopping in one direction or another. But that old trend is done. And the reason it's done is we fell too far. A pullback is only supposed to be a pullback. And if that pullback happens to go too far, then the trend is void. It's dead. Now, depending on who's doing the technical analysis, the pullback can go to different lengths. And those pullbacks can be measured through Fibonacci's or through a moving average, or there's all kinds of different ways to define how much of a pullback is allowed before it's pulled back too far. Another thing that's worth looking at is something like a MACD. There's a reason that a MACD is so popular, even though it was made in 1978, back when most people had daily data through a newspaper, because there's no way that they could actually afford, data any other way. Old school. This indicator is ancient, and yet it's still very popular. Some of the metrics that go with it. When we are above the zero line, we say that the primary uptrend is bullish. And that doesn't matter what time frame you're on necessarily. The language that you would use would still be the same. If you're above the zero line, your primary trend is bullish. If the MACD is above the signal line, then you're in a bullish trend with your bullish momentum, and you've got your bullish signal. But if these two cross over, then your secondary trend is short. You just got a short signal and your secondary trend. And it can be temporary. It could be a short-term short, or it can be the start of a whole new move to the downside. That short-term short would become a secondary, a primary downtrend with momentum. So that language gets parsed out. There's a lot to a MACD because it's been around for so long and so many people have studied it and used it. There's books, webinars, and presentations. And when it comes to using indicators, this one is one that has a lot of work behind it. So many great educators out there that has tried to explain it and use it and put language to it to help traders use this, not to find a trade. By no means would I ever suggest using something like this to get in or to get out. But this is a tool to measure things, just like a tape measure, right? Or a ruler. It's just a measurement. And it does a really good job in that measurement. So as you can see today, we have a lot on the docket. 7:30, 8:30, 10:30, 11, 11:30, and 1 o'clock. A lot on the books. Watch those additional auctions at 11, 11:30, and 1. I don't expect too much out of the EIA report, but having said that, in the current market where the European Union and we've got this incredible energy crisis going on over there. And the Bloomberg article yesterday talking about 20 million Americans who can't afford to pay their electric bill. Keep your eye on this gas report today. The market right now seems to be looking for any excuse to make a move. And sometimes the frivolous data that we normally would shrug and say, no, that never has anything of impact. Don't do that today. Really watch the clock on every one of these and be ready for some real fireworks. And what's the worst that's going to happen? Suppose you get out of a trade and you get ready for fireworks and 10:30 comes and the gas report comes out and nothing happens. Nothing happened. So what? You didn't get hurt. That would be preferred over shrugging ahead of time and saying, oh, so what? Who cares? And then it runs you over, right? And you end up taking a loss that you didn't need to take. So just be very careful right now. The market's like just looking for a reason. The volumes are steady. So I'm going to go ahead and shut that one off. No reason to leave it up there. I know I've got a lot of stuff on my screen here. I want to focus on the expected move low. Be this line down here. Last Friday, after the market closed, our expected move was measured, and that was the low end for the week. And we made that entire move on Monday. That's how far we were supposed to go in the entire week. We made the move on a Monday plus some. And one thing that we can say is we're back inside the box. And that's not too much of a surprise, since 70% of the time we expect to close the week inside the box. The trick is, can we keep it? Now we've got the 786 level. That 786 level comes from out here. If you were to snap your fib from that mid-June low to the height of mid-August, then you get a 786 pullback level, which kind of lines up in here. And as you can see, if you were to measure from the first of the year to the lows, you've got your 38.2 retrace level, and then you've got a 50% retrace level. So that's kind of some overhead resistance. Turning on all of these moving averages on the daily to point out, we hit the 10 last night, rejected off of it. We crossed back through the 4. Monday and Tuesday, we struggled with that 20. All of these moving averages right now are in play, even though they're mostly sideways. We still want to know where they are on the intraday. There's also this 200 period moving average. Right, so we hit the 10 and the 200 last night. They're lined up together. One thing that's really cool about Thinkorswim is that you can turn those moving averages on the intraday and be able to see those levels. Here we've got the 20 period daily SMA. Ten period SMA. That's the 200 EMA that we hit last night. Now, I haven't even really started to look at the weekly ones, but you can bet if we were to go over and look at the weekly ones, that we're also going to find that there's some weekly levels that are getting hit. And you want to put those on your intraday chart so that you can see, hey, are we going to hit something today? And if we're going to hit something, what is that something that we're going to hit? That way you got a kind of a gauge or a feel for what's in front of your price. And you can gauge, are we moving away from a moving average or are we moving towards a moving average? Now, the way that I was taught to do this work was on a platform that did not have this really cool indicator, right? I was taught to do it without having indicators where you could go in and do something like that. So if you're on a broker that doesn't have that thing, something like a moving average that you can show on the intraday, come out to your daily chart and get your number. For an example, this moving average up here. Just mark that. Preferably give it a label so that you can identify what it is. And when you go back into the intraday, you'll have that level. These moving averages on the daily, they're not going to move drastically through the day for the most part, unless you're using a really small number, right? Like maybe a 4 or something could possibly move a little bit, but not very much. So once you mark it, you're pretty much good for the day. We call that writing our levels, right? So you could go in, you can write those numbers down and then draw the lines on the intraday, or just hit the lines when you're out there on the daily. Get your levels marked. That way you don't have these moving averages crisscrossing and just scatter plotted all over your chart. You'll be in control of the lines, which ones are drawn and which lines are turned on and off, and how bright they are and the colors and all of that. Here on the weekly, there's nothing. We're already below the 4. We're below the averages on one side and we're above the averages on the other. Doesn't look like we're going to hit anything unless we hit that 4 weekly. So that one may be worth marking on the day. And nothing on the monthly. All right, so for today, same thing as any other day. We start with the 3 things that the market could do. One of them being that we break outside of yesterday's price action. Yeah, check, got that. So now it's, can we keep it? There's no amount of technical analysis in the world that will give us that answer. It's going to come down to how the market reacts with the rest of this econ for the day. So trying to put on momentum indicators or indicators that could gauge trend or anything like that, it doesn't apply to the idea that we may or may not hold this breakout. Especially since the breakout came from news. And we were talking about linear regression the other day and how when you get a very fast move, the market very often will reset that move. It creates a liquidity vacuum here, and the market sees that as a gap. That gap needs to be filled. So it came back down to the gap. It's filled now, it's resolved. And if the market is still bullish, then it can continue to make its move. Otherwise, if that was just a little bit of news and the market did not change its bias, then we're right back to where we were, looking for a move, looking for a reason, and we may or may not stay bullish. Just like back here, parabolic move, the move was reset. The gap was closed, and then the market continued to do whatever. ADR half 41.79, Globex high 41.87, full ADR at the cog line 42.11. That is really close to the high of the CPI day. I marked that high. Of course, I also marked that low, but it's way down here. Notice where the market stopped, by the way. That must have just been luck, right? Broken clocks are right twice a day. If we fall back inside, this will be our range for the day, and it's still the base case argument. This is the thing that I'm believing we're going to see more than anything else, is that we're going to come back inside that range. Now, I've been wrong before, and I'm okay with that, right? You can't get it right all the time. The third argument would be that we break out of the bottom of that range. I find that the least likely scenario on the day. Out of everything that we could do, breaking lower than that low of yesterday, I think it would take a significant amount of negative news, and it wouldn't be a surprise, right? It wouldn't be subtle or soft. If we're going to make that move, it would be pretty extreme. All right, so that one, you'll see it coming. So if my base case argument is wrong and we don't stay in the inside of yesterday's price action, then I think we're going to stay in the new price action that we have today, which will be basically this zone right here from 41.88 to 41.58. That's a 30-point range, but for the last 2 days, we've been in a 40-point range, right? And we're expecting less movement as we get closer to Jackson Hole meeting tomorrow. They call Powell a volatility suppressor, right? Because when we get closer and closer to an event, the market quits moving. Volatility is the nerd word for movement. So if we quit moving as we get closer to an event, it's because volatility is decreasing and decreasing and decreasing. So what is Powell? He's a volatility suppressor. Well, the market is like a living, breathing thing. And what we've learned out of nature is you don't compress nature for too long because she'll blow up on you. That's why they let water out of dams, right? You have to let the energy out. Otherwise, it just keeps winding up more and more and more and more energy until it explodes. We could see this move this morning as a little bit of release of that energy, right? Like somebody popped a release valve. But I don't think it's done. I think there's still a lot of energy wound up in there, and we're likely to see a pretty big size move. One of the reasons that I believe that that big move is coming is because of the rate funds and the hedge funds that are short right now. They are heavy short. If we catch them off sides, then we're very likely going to see a significant move. All right. Powell seems to be mistaken constantly. That he'll come out chipping his teeth and everybody will say, I think he sounded dovish, whether he was dovish or not. So if they read him as dovish tomorrow and the market pops to the upside, those rate funds and hedge funds and VC funds are all going to be off sides. And it should be an epic squeeze to the upside. And if you're wondering, how do I know what the hedge funds and the rate funds were doing? I read the article. This article link is in the Bullish Bears Discord chat. You can just scroll up to yesterday morning when I shared it then, if you want to read it. Now, we did have a break in the VIX yesterday below 23, which had been our benchmark. That should have been like pouring gasoline on a fire, and we got nothing out of it. So yet again, this disconnect between the VIX and the rest of the market. And the skew's off, and the put call ratio is off. There's moderate buying on the call side in the SPX, excuse me, the put side in the SPX, and moderate buying on the call side in the VIX. want to continue to see that dollar fade. It's going to provide a little bit of tailwind for the market. Now, they're not directly inverse like a teeter-totter, right? One side goes up, the other side goes down. It's not exactly like that. It's more of the idea that if the dollar stays elevated or worse, even goes up more, that it's putting pressure on the market, right? Trying to push it down. The analogy that I use is if you take a balloon out to the pool, instinctively it wants to go to the surface of the pool. And you can push it down and it'll go under. But you have to stay right there pushing it down. And if you let up, it's coming up. Well, the market instinctively just wants to go up. It's these negative pressures that push it down. So when the dollar fades, it's taking pressure off that market, giving the market the freedom to move up if that's what the market wants to do. Unless there's other weights and pressures, like the bonds. We are looking for that rotation in energy. This ratio chart is one of the most powerful charts, ratio-wise, that you could come across. Out of all of the sectors that I could pair, none of them would be better than this one. Now, this is basically consumer discretionary against consumer staples. But I've heard it, offense versus defense, all kinds of different phrases. Household goods or staples are doing good when this thing is going down. And frivolous spending, casinos, cruise lines, fancy cars are doing good when this is pointed up. And as you could tell, when we were coming up off of that July low or June low, discretionary was doing better than staples till we rolled over the other day or the other week, started heading back the other direction. This is a weekly. So we come in and put it into the smaller time frame. Starting to get that tick back up. But one day, one little tick isn't enough. Technology versus energy. We're seeing energy doing better. Instinctively, we would want to know, is that rotation coming through yet? And the answer is yes. Right? When this thing is pointing down, energy is doing better than technology. It's stronger. It's got more money flows. So the market may not have taken that impact by much yet. But the pair says energy's a lot stronger than tech right now since that rollover the other day. And it actually started a little bit early. And then stocks versus bonds. When this is pointing up, stocks are doing better. When it's pointing down, bonds are doing better. Bonds are doing better. On the 10-2 yield curve, we're still inverted. We're still below the zero line. All right, 10-day, 30-minute chart. We're at the point of control. It's right under our feet. If the market is to fade back down around that 4120, 4130 area, that'll be where the most volume is at. It'll be where it gets the greatest assistance. If we break below that CPI low of August 10, that would be basically the cog line, 4111. If we break below that, shallow fall. Now this is the hourly chart because I forgot to set it back the other day. So we're going to take it off the hourly and put it back on 10-day, 30-minute. Now the point of control is a long ways over our head, 42.73, and there is a significant volume bar of resistance around 42.20. For us to be able to get there, we'd have to get through that CPI high day, 42.13. And it's really shallow. So if we were to start making that move, we should be able to make that move relatively easy. All things considered, right? It's really shallow through that area. And the same thing, if we are to fade to the downside, 4120, 4130 would look to catch us a little bit because we do have a significant amount of volume down there. The value area low is 4125. If we break below 4130, there's not a whole lot down there to catch us, right? Open zone, shallow area. We're likely to fall through it quickly. Five-day, 5-minute chart. We still have that VPOC at 42.30. We've got that 786 retracement level that we're flirting around with this morning. And you're really going to want to go in and mark out all those moving averages that we talked about. At the very least, just know where they are. You don't have to trade them. Right? You just want to know, oh yeah, we're about to hit that thing. Yep. In the bullish bears chat, in the stock and options chat, this is from Spot Gamma. Oh, excuse me. It's from Tier 1 Alpha, not from Spot Gamma. My bad. The VC funds, which are largely tied to the variable annuity industry, systematically manages around $250 to $450 billion asset under management, AUM. As realized vol rises, these funds generally sell equities, adding to a sell-off. As it falls, these funds or as it rises, these funds buy equities supporting the bulls. Right? So we've talked about that before, how if the market breaks out of the expected move to the upside, the funds have to buy into the buying to get to delta neutral. And if we break out of the bottom, the funds have to sell into selling to get back to delta neutral. Right? That's not new. It's not a surprise. It was just reiterating the same thing that we always talk about. We're seeing that rotation everywhere in the options market, in the parity market that we were just looking at with ratios. It's all over the place. All right, so the question that's being asked here is how many names are up in the pre-market? At least 0.5%. 35. That's not too bad. It's slightly bullish. It shows constructive movement this morning without extreme movement. We wouldn't want, 90 names up in the pre-market. That'd be too extreme. On the names that are up, Autodesk, D-Dog, and Tesla are some of the highest names. The gap is more than 3.5%. Technology is mostly the names that we're looking at. There's more technology than anything else this morning. So it's going to be a big focus on the monsters of tech. And what I always like to do on a morning like this is check the other number. How many names in the NASDAQ are up 1%? 19. Okay, that's a pretty good number. When we get above 25 or closer to 30 numbers, then it kind of gets my attention as a little too much. Amazon, Facebook, Tesla. I don't see all of the FANG names, but a number of them. That's a good start, but I'd be wanting to know where the rest are and if they're going to be coming in or not. The other day, Tesla was fighting against Apple and Microsoft. So, we want to see that they're all coming together. All right, take the same question but put it onto the S&P. How many names in the S&P are up 0.5%? Almost 50% of the S&P this morning. That's insightful. I want to know on the S&P side of things, how many of those names are finance? Not as many as I would have expected. And it is the usual suspects. JP Morgan, Bank of America, Wells Fargo. There it is. Wells Fargo. So we want to tighten that up. How many names in the S&P are up 1%? And which ones are they? All right, a couple communication names. Comcast, Netflix. No Disney? No Disney. Not yet. Some of the legacy names like GE and Ford are up this morning. Yeah, volumes are kind of light on some of those names though. All right, so we can see the projections here on the Elliott wave. And I don't know how to draw Elliott wave myself. I'm using an indicator. You gotta always add a little bit of salt when you're using an indicator to do something like that. Still, it has a lot of merit. A lot of eyeballs went into it, and if it was trash, you know, the expectation would be that nobody would use it. The next leg up, if we happen to maintain this stability, would be to get through that 200 period moving average. And we're looking at around 44.11 for the next reversal, the next cog line. And if things were to go parabolic and we get a strong leg up, then we're looking at around 45, close to 46, which would put us back to this pivot point from March when we had that FOMC announcement and then the rally up. Not will. In the chat, Jeremy said metals, lithium, and graphite will be in a rotation. They are in a rotation. They have been the names in the last few days, especially adding to that the news that came out of Japan with them going back to the reactors. Right, Japan's going to try to cycle back through nuclear again. If you scroll up into the chat that I was posting yesterday, some of the names that were moving was in that industry too. All right, so this is the expected move for the week. Think about where the ES is at right now. We're at around 41.63, which would put us opening here in the SPX above these two levels. That's an IX10 breakout. Now, I often talk about strategies with people and they say, well, I want to be a trader and I need some strategies. What do you got? Red to green, inside day, IX10, TRB, and 52 week. And you could even do something like a 14 day, new highs, new 14-day highs, 52-week highs. There's a lot of strategies, right? And they're not complex strategies. An IX10 or an inside day breakout. Simple enough. We're looking at price opening up here outside of that price action from the other day. We are opening gapped up outside of yesterday's range. Now, in a lot of names out there, we may not be all the way out yet, right? We may be up off of where we closed, but not yet high enough that we've broke out. at which point we're going to be looking for the market to break out, maybe give a Busby, and then go. On Monday, we opened gapped down, and we moved farther away from the gap immediately. It never turned around. That first bar was a Marbozu candle, and it just expanded and kept going. Today, we're going to be opening gapped up the other way. It's going to look a lot like this at first. We're going to open gapped up. The first thing we want to focus on is, where's the market going? Is it moving farther away from the gap, making the gap bigger? Or is it immediately moving down to close that gap? That's what you're going to want to focus on this morning. The very, very first thing. Are we going to close the gap first before we do anything else? So if that first candle continues to move farther away from the gap, it becomes the controlling candle of the entire day. That's the boss. Then you're going to look for an inside day, a 5-minute breakout, not an inside day breakout, but a 5-minute breakout. Going to be looking to see which side of that candle do we break out of. Now in the futures market, we've got Globex values. And one of my trade setups that I like, I don't have a name for it yet, but it's where we set a high before we come into the open. Say we open down here, the market opens, we get all that juice, we rip to the upside, bounce our head, and down we go. In that first rip, it brings in all the newer traders that are scared they're going to miss out. They all buy into it. You might even get a little bit of an excitement through the top of that zone just to trap them and then dump it on them. Now, since we've got 2 of these, the concern is that we might make it through the first level and get to the second level. We call these reversal zones. They are a spot where the market has the most likely place of reversing. So I'm not telling you, oh, well, it's going to reverse there. It's not what I said. If the market is going to reverse, these are the places where it's most likely to happen. When you're looking at your charts, always be thinking, where's the next reversal zone? And you want to mark those zones. Where does it have the most likely chance of reversing? If price gets there and just runs right through it, then okay, obviously that was not the place where it's going to reverse. Doesn't mean you did it wrong. It just means that it didn't reverse there. It was a likely reversal zone that didn't pan out. Focus on the next one. And I see too many traders who say, I marked it and it didn't stop there. It works sometimes, but it doesn't work all the times. Well, no kidding. Nothing works all the time. You still didn't do anything wrong. So watch those reversal zones this morning and keep in mind our base case argument is that we're going to go back in the box. The second likely outcome is that we're going to hold the range from our Globex high to the Globex open. And the third one will be that we continue the breakout. The last least likely scenario, we come all the way back down to the low and break the low. I don't believe that one. Everybody be careful, be safe, have a good one, and I'll see y'all tomorrow.